So how did I raise £11 million at 27 years old to buy 70 houses? Okay, I own a lot of rental properties in the UK. I also buy and trade and buy and flip houses every single week of the year. I have a £6.5 million portfolio, and to do this, I've used none of my own money. Everyone thinks when you start in property that you need a lot of money, and you just don't. I started with nothing just after leaving university, and this is basically what I've done. And the thing to start off with that you need to realize is that raising finance is an art form, okay? And you need to learn this art and understand the art of raising finance before going doing it. And that's what I'm going to go through today. And there's also two types of people that you have in this life. You've got people that take massive action and go and do the things that I will tell them in this video, and they will go and raise finance. But you've also got the people that won't take action. And if you are the person that does not take action, I can guarantee you that you will not raise finance. And you ultimately need to couple together the art of raising finance, so the knowledge side of it, with the action side of it to be able to go and do it. So I'm going to go through that today. I have a big mirror board that I'm going to take you through, and we're going to go through quite a lot. So let's jump into it. But for those that don't know who I am, I went to the University of Leeds to study geography, most pointless degree in the world. I raised £6.5 million. I bought £6.5 million worth of property just after I left university and started deal sourcing. My current gross rent across my portfolio is 65k a month, with net around 32 to 40k depending on the month that it is. I own the UK's most exclusive property network, the AFPI network, and I also own a software company. So what do I get out of these videos? Because everyone always says, why do you make these videos? Why do you tell us everything that you know? Well, there's a few reasons. Number one, I like sharing. I wish I had these when I started. Number two, full transparency. I'd love you to join my property network. It is the most exclusive property network in the UK. I genuinely know, hand on heart, it is the best property network in the UK. And we've helped people from the very start who don't have a clue about property, but they've always wanted to get into it, to Premier League footballers with millions of pounds. So we know what we're speaking about. But other than that, if you don't care about number two, you don't want to join my network, no problem at all. At least you can watch today's video and think that he was an all right guy and he gave me a lot of value. So next up, let's just go through some proof. This is one of my rental properties. You can see down here, £2,839 in profit. You can see Palmerston, 3,766 in profit. And I've got 26 of these HMOs. This is one of my companies. You can see the fixed assets here. This is another one. You can see the assets here. And this is another one. You can see the assets here. And I've probably got another 10 companies. So you can go in company's house. It's not rocket science. Go and find me and see for yourself. So what are you actually going to learn in this video? Okay, because that's probably why you clicked on the title of this video. You're going to learn like how people have been raising finance since the beginning of time. Do you actually need to do it yourself? Like in the position you're in, you need to raise finance. Understand the mindset to raising finance, the compliance. This is huge. 99% of people that you see on Instagram break FCA compliance every single day when raising finance. Okay. Like that is so important. Everyone breaks it. How to structure the deals. So joint ventures or loans. Some client wins from the clients that I work with. So you can see some more proof as well. What security can you offer investors when you are trying to work with them? The strategies on how to raise finance. I'm literally going to tell you how to go and find investors and raise finance for yourself. What rates I pay investors and what the next steps are to take, as well as some FAQs at the end. So let's get straight into it. So what is raising finance? Do I need to do it? And how do I do it? So let's start with, do you actually need to do it? Okay. Well, you need to do it if you don't have a lot of capital yourself. And you need to do it if you want to scale quicker than just saving up the old fashioned way of save 25 grand, put it into a buy to let, and then wait another 10 years to save 25 grand. Okay. You might need to do it if you don't get paid enough in your job to save that amount of money. And this was me back in the day. I was getting paid 25 grand a year. There's no way I could save my wage, okay, and go and build a property portfolio. It just wouldn't work. Like I'd be dead by the time I had 10 properties. It's as simple as that. You also want to raise finance if you want to be smart and play the game, okay? And you don't want to get overtaken by others. So when I started, I had nothing. And if I'd gone through the saving up method of just waiting to buy my buy to let, everyone would have overtaken me because everyone is raising finance. The people you see with big portfolios, they've all raised finance because it's pretty much, unless you've got a massive war chest yourself, impossible to do it otherwise. Okay, and you want to build a large portfolio that replaces your income. I wouldn't do it if you want to go the slow, old-fashioned way. So save, buy, and you want to go slow. But also, I wouldn't do it if you want to miss the opportunity cost in missed income and growth over the period of your lifetime, which, by the way, is absolutely massive. Okay. And a caveat here is if you are not educated, do not do it. Okay. You wouldn't drive a car without lessons. So don't do property without the education and the knowledge, which I'm going to give you today. I'm just going to give it you for free. Okay. You've got My Property Network, you've got other people's courses, you've got YouTube like this, Instagram, books, etc. Go and understand the art of raising finance. But most importantly, go and understand property, the strategies that you could do, like how to analyze deals, how to network, how to speak to investors. All these things are super, super important, okay? And just to put it into context, the total cash used to build my HMO portfolio was £3.24 million. I was getting paid 25 grand a year before I started building this portfolio. This means that if I was in my job, I didn't get taxed and I didn't spend a single penny of my income, I would have had to save 129 years before I could have this amount of HMOs. But I did it in 12 months. And so by raising finance, I saved myself 128 years. Just let that sink in. By raising finance, I saved myself 128 years of my life, which is insane. Okay. Now, this is not a new concept. When everyone thinks of raising finance, they think it's like some new strategy. This has been going on since the beginning of time. Okay. When people are borrowing money to go and buy a car in the olden days, they would ultimately raise finance by borrowing it off somebody else and then going buying it and paying the money back with interest. And I'm just going to give you a few examples here that are really cool to understand. So this is One Hyde Park in London. It's the most famous development ever done in London. Some of the most expensive apartments on the entire planet. And this was done by the Candy Brothers. Here's the Candy Brothers. And these guys started off with a 6K loan from their grandma. And they bought a flat in London for 122 grand. They sold it for 172 grand. They made a profit and they've gone on to build a development business. So these guys started on 122 grand property by raising finance of a £6,000 loan from their grandma. Okay. Now they built this and one apartment sold for 175 million pounds. So they've gone from 122 grand to 175 million pound development projects. Okay. And they couldn't have done this without raising finance. So for One Hyde Park, for this development here, these guys did a joint venture with a company called Water Knights. So it's a Gulf-backed consortium run by the Prime Minister of Qatar. So the Candy Brothers bought the deal and the experience, their experience of loaning money off people or doing joint ventures and doing the deals. And then Water Knights brought the funding, which was 1.15 billion pounds of it. And the point is that the Candy Brothers could not have done this deal without a partner. And property requires funding partners. In whichever way you want to look at that, it requires it. It's so, so important. And so you guys have to go out and raise finance if you want to build a big property business. Next up, we got the Shard. Obviously, everyone knows this building in London. Everyone thinks that this developer just had a load of cash. It's just not true. A developer built it called Stellar Property Group, and they did a joint venture with the state of Qatar. So the Stellar Property Group bought the site and the construction background, and the state of Qatar brought the funding. Again, property requires funding. So these guys and the Candy Brothers have become a master at networking and raising finance. We then look at Blackstone. So Blackstone have a real estate portfolio of 596 billion pounds. When we're talking about raising finance for most people, it's 100 grand, 500 grand or £1 million. These guys have raised 320 billion pounds of investor capital to build this portfolio. Now, if this doesn't show you that you have to go and raise finance to build a portfolio, I think you should just click off this video right now, because This is a crucial thing you have to understand in property, okay? And I'm going to show you how you can do it today, how you can go away from this video and crack on and start doing it. You then got Lloyds Bank. They want to be the biggest landlord in the UK. They want to buy 5,000 houses over the next few years. And all of this, you know, Lloyds Bank, the guy who owns it, isn't just paying for all these houses to be a big landlord. He's borrowing this money. They're borrowing it off pension funds, off their own clients, off insurance companies. They borrow this money, so they raise finance, they buy the asset, they get it income generating, they refinance, and they pay the investor back plus interest. So property requires financing, okay? And the big thing to take away is that if these normal people can raise hundreds of billions, you know, you look at the Kennedy brothers, they started off £122,000 flat in London, and then they sold an apartment for £175 million, okay? It seems unreasonable that you can't raise 100K. And this is the mindset that you need to have. You need an abundant mindset. You know, you can do it. You genuinely can. It is not hard. It's one of the easiest parts of property is raising finance. But so many people have this mental block. And you need to understand that there's so much money out there and loads of it has got your name on it. Okay, so you need to go out there and get it. Let's just look at some client success that we've had within the network. Since May last year, we've had £18 million raised by members, 150K last week, 200K this week. Didn't know it was this easy. AFPI all the way. Hope everyone's having a good one. 600K JV agreed with investor. 50K here, £190,000 here, £2 million raised here. With the 2 flips money raised, just total under $1 million so far. This is for him. He started with us about 9 months ago, and he's raised over £1 million, which is awesome. 50K from someone that I met at a mastermind and just gave him a bit of advice. 500K for next year to go in with. Another 500K here. 250K here through great mentorship. 100K, 300K, 350, 80, 350. 150, you get the gist. I could put another 100 screenshots of this from AFPR Network in this Miro board and this YouTube video. Go look at my highlights on my Instagram, Aston H Property, because you will see a lot more of them there. But let's talk about mindset next. You need to understand that raising finance is a process, it's an art, and it's a really, really simple blueprint that you can follow. However, it doesn't mean that you're going to get results tomorrow, okay? I've helped people raise £1 million in a week, but I've also helped people raise 100K in a year, because it depends on the input and output equation that we spoke about at the start. However much input you put in and knowledge you understand basically will give you results in the time frame that you deserve, okay? And something from Hormozy, which I'm going to touch on quite a lot in this mindset section, is hard work without results does not mean failure. It means that you're in this growth phase, the invisible growth phase. And Chris William does a lot of podcasts on this with Alex Hormozy, and I think it's amazing way to look at it, okay? And imagine planting a seed in the ground. For weeks, you water it daily, nothing happens. So this is like you going doing some outreach or speaking to people and nothing happens. There's no sign of anyone giving you money, okay? But beneath the soil, the roots are developing. They gain in strength and they break through the surface. And this is exactly how success works in property. Property is not quick. You might spend months analyzing a deal, building relationships, speaking to investors, but you don't get any immediate returns. But each action, each KPI that you are going towards, which I'll give you some KPIs, is laying the foundation for future success. A lot of people come into property and they start deal sourcing and they don't sell a deal for a year and they quit. They don't sell a deal for 3 months and they quit. When I came into property and started deal sourcing, it took me 9 months to sell my first deal. 9 months. If I would have quit, I would have been in my shit-ass 9-to-5 job right now. Yeah. And I would have been in a completely different position, not being able to travel wherever I want, not being able to buy whatever I want, not being able to live off rental income and build all these other fun businesses and spend time with people that I care about, okay? And that's one of the biggest things, is just don't give up. And he talks about the pain period as well. And this is the phase when you're putting in massive effort, but you're not getting any rewards. So most people quit here, which is what I was just saying. Most people quit when they start deal sourcing and they get no rewards. Most people quit when they try and raise finance, but they feel like they've hit a wall and they can't raise any more. And This is where people quit. But the truth is, results don't come on a predictable timeline, especially not in property. I will tell you that, okay? And it rewards consistency, though, as an industry. The more work you put in, the more you get out. And the deals that seem impossible today might suddenly become effortless tomorrow. And I've seen this firsthand. Deals that I could never have dreamt of doing. If you look on my Instagram, I bought a building in Manchester, Piccadilly, M1 postcode. I used to walk past this every day. I used to go to work. And 4 years later, we bought it to do a development. So these deals that one day seem so far away aren't actually that far away. So here's why most people quit too soon. It's because the world that we live in, it craves instant gratification. Most people crave it because they see on Instagram, they see people doing 10 HMOs in a year, 50 HMOs in a year. They see people flipping and making 100 grand and they want it, but they're not willing to put the work in. And you feel like you're falling behind. But what a lot of people don't see is the years of struggle that person has had, behind the curtains. So you need to understand that. And the time between work and the reward is unknown. And this is the hardest thing about being an entrepreneur. You can put work in for 10 years and you don't know when your big result is coming. And that's super hard to deal with, okay? It's really hard to deal with from my personal perspective because I want the instant gratification. Of course I do. Everybody wants it. But the good thing I now have is the knowledge that it's not just going to come straight away, okay? So let's look at compliance. So when you're looking at compliance for raising finance, let's get my face out of the way. You've kind of got three different buckets of people. You've got high net worth investors. So this is somebody with 100K or more, or £250,000 in assets, but not including the personal residence. You've then got somebody who falls into the bracket of self-certified sophisticated investor. So this is when they meet certain FCA requirements about investments or knowledge. And to do this, they can fill in a self-cert form down here. Then you've got the unsophisticated investor. So as the FCA, this is the people that they're trying to protect everybody, right? But the unsophisticated investors are the people that are, I guess, the most at risk of being taken advantage of by fraud and financial crime. So these people are massively protected. So this is somebody that isn't a high net worth and can't self-certify as an investor. So the way you approach these people has to be very careful and extremely different depending on what category the person falls into. So if somebody's an unsophisticated investor and you go up to them and say, can you loan me 100 grand and I can give you X, Y, and Z and look at all these other deals that I've done, that is breaking the law. As simple as that. And most people do not know that. They don't meet the criteria, and therefore you can literally give them zero financial promotion, which is, I was going to say insane. It's not insane. It's good because it protects them. But the insane bit about it is that 99.9% of people you see on Instagram are doing this completely wrong. If I post an Instagram story saying that I want £1 million and I can give this and I can give that and I can do this for you and I can stand on your head and dance and all of that crap, well, out of, let's say 13,000 followers, how many of them are unsophisticated? There's a lot of unsophisticated investors. And that is then seen as me just doing a massive mail blast out to loads of unsophisticated investors, getting a load of leads in, and essentially breaking FCA regulations. So you have to be very, very careful on that. And inside the AFPI network, I go into heavy detail on these three categories because I think it's super important. Does it mean you can't work with unsophisticated investors? Absolutely not. You 100% can work with these guys. There's just a strategy in the way that they approach you and the way that you need to market yourself, okay? So you can work with all three of these people. Everyone works with all three of these people. I work with loads, each one of these categories, and you just need to know how to do it. Now, what security can you offer investors? So the reason why this is important is because when most people come to raise finance, they're scared about the question of, what if they ask me how they're going to get the money back? What if they ask me, how is my money safe? What if they ask me, how am I going to make sure you're not going to run away with the money? And this is where security comes in. So what security, if somebody loans you money, what security can you give this investor? And it falls under a few different brackets. You can give a personal guarantee, a loan agreement, shareholders agreement if it's a joint venture, or charges. So a personal guarantee is a piece of paper you go into the solicitor and you sign. You are personally guaranteeing that this person's giving you 100 grand and you're going to give them 100 grand back. And the personal guarantee essentially says if you don't pay it back, they can come after your personal assets. So the house that you live in, the cars that you have, the nice Rolex you might have on your wrist. But one thing I would say is this sounds very doom and gloom. With the clients that I work with, I explain it in a way where it's not as doom and gloom as you think. I sign personal guarantees. Some of my friends sign personal guarantees for tens of millions, hundreds of millions of pounds. And it's not as bad as it seems because ultimately you are still buying the asset. Okay, so you still got that underlying asset value underneath, which means that you most likely are able to exit the deal, worst case scenario, on the open market, get the money and pay the investor back. A loan agreement is an agreement between the investor and yourself. So, who's loaning the money, who's receiving the money, and what are the terms. So I'm going to loan this money for 12-month period. I want a personal guarantee and a charge. I want 12% interest. I want my interest paid monthly or rolled up at the end of the term. If there's a default on the interest payment, I want X amount more interest. If there's a default on the initial capital period, capital amount coming back in the 12-month period, maybe that's fine. Maybe we can just roll it over into another monthly rolling thing, but the interest goes up. Whatever that is, this is the legal agreement between you and the investor in terms of what the loan is. Shareholders agreement is a little bit similar, but a little bit different. So I'm going to go through deal structure over here in terms of loan agreement and joint ventures. But shareholders agreement is for a joint venture. So if you go 50-50 in a joint venture, what are the roles and responsibilities of each party in that joint venture? Does the investor put the money in and you do everything else? Or does the investor put the money in? Does the investor help with the refurb and you find the deal and you project manage the refurb and you deal with the exit? Like what is the agreement between you and this investor? And that's what's covered in a shareholders agreement. And then charges. So you have different levels of charges. You've got first charge, second charge, etc. And this is ultimately the pecking order on who gets paid first. So let's say you do a flip, you buy it for £100,000, you spend 50 and you think it's worth 200. So you want to make 50k profit. As an investor, you can offer them to have a first charge on the asset, which means when they put their 150 in, so the purchase and the refurb, they get that back first. So if it's sold for 200, they get the 150 first and a share of the profit. Or if they're on an interest and not on a joint venture, they get their 150 plus their interest, and then you get the profit. So it's like the pecking order of who gets paid first. Second charge, obviously, is below first charge. So if you went to a bridging lender, for example, they will typically always take first charge, so they get paid back first. But let's say you had a bridging company give you 75% of the asset, so they give you 75 grand out of 100, and then the other 25 is from an investor. The bridging finance company, because they put the most money in, will want first charge. But if your investor wants first charge as well, who's put 25% or 25 grand in, you can't give two people first charge. So he will have second charge. So he's going to get his money back second after the bridge, which means if you lose money on the project, then this guy who's got second charge might not end up getting his all of his capital back. And if you've signed a personal guarantee and a loan agreement, whatever he can trigger in the loan agreement or the personal guarantee, they might come after you for the shortfall. Now, all of this seems like very scary stuff. In a way, it should be, because when you're borrowing other people's money, you have to treat it like your own. You have to treat it with respect, and you need to know what you're doing. But it's also one of the most beautiful things in property, to be able to use other people's money to build your wealth and your portfolio. And we've done that very successfully. Like I said, we've raised £11 million. I will probably raise closer to £100 million over the space of my career. I'm only 27. But if you couldn't use other people's money, I couldn't do what I do now, and I'd be in my 9-to-5 job. And if you have the knowledge and understand the art of being able to do it well, it's the most beautiful thing in the world. And this is just an example down here of a capital stack. It just shows how money is put across a project, and this is typically for a development project, but you can see down here senior debt. So ideally, 100% of this, let's say this is 100% of a project, ideally 100% is investor financed, and therefore the capital stack in a way just doesn't exist. However, in the example I just gave you, this equity piece here, let's say this is all investor finance and the debt piece is all bridging finance. You can see here the risk and return. So the risk for the senior debt is less because they're going to have a charge on the asset, and they might typically give you a lower interest rate. However, the equity piece up here, which might be the investor finance, the risk is a lot higher. And the risk is higher because they don't have first charge, and therefore they might charge a higher rate of interest. But for me, my typical terms, I typically get money loaned to me at 1% a month. So over a year, that's 12%. So if I borrowed 100 grand, I would pay back 100 grand plus 12 grand at the end of the year. Sometimes I'll give a charge. With a lot of my purchases, I'm purchasing at speed. So I'm buying houses within 1-2 weeks. I've bought houses within 2 days before. So to put a legal charge on the title will take too long. I'll always have a loan agreement. I'll always have a shareholders agreement if it's a joint venture. And sometimes I will give a personal guarantee if the investor asks for it. So let's look at deal structure, and then we're going to go on to how to find investors. So deal structure, you've got two different ways. You've got a loan agreement, and then you've got a joint venture. Loan agreement is when someone sends money to you, you sign the loan agreement, and you are ultimately the only person in the project. Someone's loaned you the money, and you go and do the project, you make the money or lose the money, and then you have to pay them back at the end of the term plus interest. So you need security in place and you need compliance at the forefront of your mind. And then a joint venture, 50-50 split. Somebody puts the money in, you do the work, you sell, you split the profit, everyone's happy, you do it again. But again, compliance in mind for this, because there are certain things that you have to have in a joint venture when it comes into FCA compliance. So what are the pros of both of these? So the pros is that you don't have to profit split if you're doing a loan agreement. You've got full control of the deal, so you've not got anyone nagging in your head about, we need to do this in the refurb, we need to do that. And there's no long-term commitments, okay? If you're in a joint venture and you get stuck in a deal, you are potentially having a longer-term commitment there. But the pros of a joint venture would be that you celebrate together. And this is a big one. If you win and you make 50K and you make 25 grand each, how amazing is that? That you get to celebrate this moment together, that you both made money. You've made money because both of your skill sets have aligned, okay? But you also struggle together. So if you struggle when you've loaned money off someone and you're in a really, really bad position, who can you go to? Like, you're in it with yourself, other than if you've got a strong network, which is what I offer. But in a joint venture, you struggle together. Two heads are better than one. Okay. And it also allows you to expand your network, because this person might know somebody else who wants to do one, and somebody else and somebody else. And it might get to the point where you're doing 5 joint venture flips in a year, and that 25K profit is now 5x, and you're now making over 100 grand a year by flipping 5 houses. Now let's look at the cons. The cons to a loan agreement is there's no strategic value. So the investor's not bringing any value other than the money. Okay. Whereas in a joint venture, this investor might bring some strategic value to you and to the table, which is awesome. You have to pay back the loan regardless of success. So if you lose money, you still need to pay the money back, still need to pay the capital back, plus the interest. You're not sharing any risk, so all the risk is on your head because you borrowed money and you want to take it all for yourself. And there's also a higher level of pressure. Anything goes wrong, it's on you. But what are the cons of a joint venture? You have to split the profit, but this is also a pro, like I said up here, because you celebrate together and struggle together. It's not just a con. If you have a bad JV partner, now this happens more than you think, and this is when people don't vet their JV partners properly, which is what I can help with. If you need help, click the link below in the description and to book in a call with the team. And also, if you've got a JV partner with different goals. So if I get into a joint venture and we both want to hold this house together, and we want to split the rent every single month when we've refinanced it. What happens if 2 months down the line, my joint venture partner gets divorced and needs to sell the house? Or what happens if they've got a change of mind and they want to start selling because they want to move to a different country? But you want to keep it. You want that rent for the rest of your life. Well, this is where you've got different goals and you've not identified this at the start. Sometimes life happens, things happen outside of your control, but it's just very, very key when you're speaking to investors that you understand what their goals are. So let's go into how to find investors. So we want to raise finance, and to do this, we need to find investors. But the first thing we need to do is build an ICP. So your ideal client profile. So a lot of people go out and try and raise money, but they don't know who they want to raise it off. They just want to hopefully have someone message them on Instagram and raise that money. So for me, I'm going to give you a bit of source. These are my ICP. A husband and wife, a young entrepreneur who's successful, and someone that's overseas as a high net worth. And typically, also another one that I've added in here is a 35 to 50-year-old male who's in a job in London, Manchester, and has been in a good job throughout the entire of their life, maybe 100 grand a year, and they've saved up a pot of 100, 200, maybe they've done property before, but they can't be bothered with the stress of it anymore. These are my ICP. I suggest you take this, do what you want with it. You can have different ones, obviously, if you've raised money from different people, but this is just mine. But one of the things you need to figure out is, why should they invest in you? What is your value? Like, why should somebody give you money? And so you need to figure this out. And a lot of people don't think about this, but here's some reasons why. Maybe you're a builder, which is awesome, because if you're a builder, the two biggest risks in property is finance risk and development risk. But if you can cover the development risk, tick. Are you really good at sourcing deals? Can you find the best deals in the market? If so, then this is why someone would invest in you, because you can find great deals. Are you personable? Property is a people's game. People give me money because they like me. Okay? If I was half decent at property, but I was likable, people would still give me money. Okay? So it's a people's game, and it's your ability to network with people. Have you done past deals? If you have, awesome. It will be easier to raise finance. But if you've never done deals before, you can still raise finance. 1 trillion%. And sometimes it's actually better, which is a really interesting thing, and I'll go on to it in a minute. Are you trustworthy? Can you show that you are trustworthy? Do you have good market knowledge? Do you have a good network, a good reputation? Again, comes back to building a personal brand. Are you new to the game? Now, this is what I mean by past deals. So if you are new to the game, people like this, because from my perspective, would I rather give somebody 100 grand who's doing 10 deals at once, so that I'm getting 10% of their effort, or 100 grand to someone who's put 100% effort into my deal because I'm hungry, because I'm new to the game and I want it to work, and I'll do every single thing in my power for it to work? I would give it to the person new in the game, personally. So this is why that can act as a big benefit to you. Work ethic. Have you got a good work ethic? Have you got a good vision? If you sit there and go, I just want to do a flip a year until I die, like, that's not a vision that someone's going to buy into. Do you want to build the next One Hyde Park? Do you want to be the next Candy Brothers? Do you want to sell apartments for £175 million? Do you want to do a joint venture with the royal family in the UAE? Is that your vision? Because if it is, do you want to build skyscrapers in Manchester? If that's your vision, you are going to attract more investors. It's going to be a lot easier. And also your resilience. Can you show resilience when things have gone wrong in the past? Because things go wrong in property all the time. I'll tell you that for free. And if you can show resilience, then this is going to be good for investors. So how do we actually find investors? Okay. So there's probably about 20 ways, and I'm going to give you a few. I can't give you them all because people paid me a lot of money for it. But here's a few very, very easy ones that you can do. Friends and family. So the people that are closest to you. This is what I call the low-hanging fruit. Do you have people that are close to you that have got money? Maybe they're retiring. Maybe they have retired. Maybe they've got good pensions that they can take 25% tax-free out of. Have they got an unencumbered property? Have they got unencumbered property portfolio? Have they saved up? Have they got crypto that they've made a load of money on? Speak to these people. Now, the key is how to speak to them, how to open up the conversation. And I'm not going to tell you the exact way because I'd literally be here for hours. But one of the ways that you should sort of like frame it in your head is have no friction to the conversation. It's not, hi, can I borrow money? Because first of all, that might break FCA regs. but it's hi, can we meet for a coffee? I have something that you might be interested in. Low friction. Go and meet them. Find out about their goals. What do they want out of life? Do they want more cash flow? Find out about them. It's super, super important. Building a personal brand. This is where up here you build your reputation, you build your network, your trustworthiness, your resilience, your market knowledge. This is where you show that. And for me, I get people messaging me all day, every day, offering me money. However, I'm very, very selective on who I work with. But if anybody wants to invest with me, joint venture or low money, just drop me a DM on Instagram and tell me you've watched this video. Join property networks. My property network. If you join my property network, I will give you £3 million worth of investor funds ready to go on a joint venture. Straight away, ready to go. £3 million. You can choose the people you want to work with and you can do deals together. So if you are brand new, this is literally your golden ticket because I'm giving you £3 million worth of investor finance to use straight away. So it's your golden ticket. So have a good network and join a good network. LinkedIn, I would not be sat on this call doing this YouTube video without LinkedIn. LinkedIn changed my life. And I always explain it at the fact that if you go to a networking event, you can't control who's there. There might be 1,000 people in the room. You don't know who those 1,000 are. You might speak to 10. On LinkedIn, I can specifically target high net worth individuals. I can build my own network on LinkedIn. I can just connect to CEOs and CEOs only. And then what starts happening is a really cool flywheel effect where you're connecting to high net worths, you're posting about property in your journey, you're messaging high net worths, you're speaking to them, you're booking calls in, you're going and meeting them for a coffee, and then you'll generate conversations with high net worth individuals that you never would have spoken to on any other platform. So get LinkedIn and use it. I use Dripify. Dripify is an automated software which automatically sends out all of your LinkedIn connections and messages. But the message is very, very important. And this is what I'll give you in the network. Proximity as well. Now, this is a simple one, but it's also quite complex at the same time. Put it simply, if you want to meet rich people and you want money from rich people, you need to be where rich people are going to be. If I go out for a drink in Manchester, I love going to Spoons. I prefer it better than Dakota Hotel. But stereotypical, there's more rich people in Dakota than there are in Spoons. It's as simple as that. I've got a higher likelihood of meeting someone rich and someone wealthy and someone in property or business in Dakota than Spoons, even though I prefer Spoons. Okay, so get in proximity with people that have got money. If you're going for a coffee, don't just go for a coffee in Starbucks. Go in. If you're in London, don't go to Pret. Go to a Mayfair hotel. Your coffee in Pret might be a £5. Your coffee in a Mayfair hotel might be £6. An extra £6, but you're surrounded by rich people. You know, you see how they move. You see how they speak. You see how they interact. All of this rubs off on yourself, and you can start generating conversations with these people in this Mayfair hotel. Because don't get me wrong, these people are there for the same reason. It's no wonder rich people get richer. It's because they spend time with rich people. And there's no wonder that rich people go to these nice places. It's because they know they're going to speak to more rich people. So this is key. Get in proximity. It's one of the easiest things you could possibly do. Me and Ollie from the network, I was telling him about proximity. We went and sat in Dakota. This is no bit of a lie. And on the table next to us were, I think, about 8 lads. They worked in the casino industry, the construction casino industry in Dubai, all the new ones are getting built. They ordered shots of tequila for us. We were doing shots. They were over watching a United game. And we got their details, and we can do business with them if we want. I also spoke to another guy in Dakota who owns racehorses with Premier League football players. He owns a lot of businesses. He makes £1 million a month in passive income. I have him on WhatsApp. I have him on LinkedIn. And if I ever need money, I can speak to him. That just proves that proximity is key. Facebook groups, I don't really use these, but there are property Facebook groups that you can post in to either sell deals in or try and make connections. Don't post in these groups, I want money. Can someone give me money? See who's active in the group. Drop them a direct message. Can you meet them for a coffee? Can you have a call with them? Find out all this stuff about these people and generate business and conversations. But all the 2 things above, okay? All of the things above have 2 things in common, and they are non-negotiables from you. You need to know your shit. You need to understand the art. I've gone through quite a lot here. this is probably 5% of what I can tell you because I don't have time. This video is already 40 minutes long. But you need to know your shit. You have to understand the securities. You have to understand the compliance. You have to understand, the other 15 strategies. You need to understand it A to Z. But also you need an acquisition strategy in place with KPIs, channels, and compliance at the forefront of your mind. It's all right having all of these because the reason I know I can give you all of these is because I know most people won't go and do it. But even if you do go do it, you need to make sure that it's scalable. You need to have an acquisition strategy in place with KPIs that you do every single day. Okay? Do you do one post a day on Instagram? Do you do one post a day on LinkedIn? Do you go to one hotel a day? Like, what are the KPIs that you need to hit to go and raise your first £1 million? Because with people watching this video, I guarantee you that you can go and raise £1 million in the next 12 months. I sometimes use the gun to the head theory. Someone comes up to me and says, I can't raise 100 grand from a property project. I'll say to them, if you had a gun to your head right now and you needed to raise £1 million for your property projects, do you think you'd go and get it? The answer is always yes. So what changes? You need to have that urgency to be able to go out there and raise money. Now, just the last few things is just actions to take away from this video and what you can, actionable things that you can go and do right now. Speak to everybody you know. Sounds simple. 99% of people don't do it. Build a personal brand. You need to get active. If you want to raise money in property, get active in the space. You need to study the art and you need to learn it from people that have actually done it. If you don't understand it, 1,000,000% you are cooked. You will not raise money. You then also need to get into proximity. You need to build your ICP, so you need to understand who you're actually targeting for finance and who you actually want to work with. Figure out why you are investable. And if you're not investable at the minute, change that. Go and do something to become investable. Okay? Because no one's going to invest in you if you're not investable. Start LinkedIn and join networks. Like I said, I can give you £3 million on a plate to go and use for your property projects. And then just some FAQs to round up. Why would we do a joint venture and give away 50% of the profit? Sometimes I think this is the most retarded question ever. Some people want 100%. But there's a reason why Jeff Bezos only owns like 20% of Amazon or 12%. Same with Elon Musk. These people trade equity for value. And most of the time in terms of Tesla and Amazon, that value is finance. And it's the same in property. So go split equity with people. Build your experience, and then you can go loan money. I do so many joint ventures to manage risk, to share the wins, to share the struggles. But I also do a lot of loans. Millions and millions of pounds worth of loans. I've done £3.6 million worth of loans with one investor. So I do both. Best ways to raise finance, join the APR network. So there's that. Go look at my highlights on my Instagram, all the wins and the wins that I've just showed you. It's an absolute no-brainer. Do you need compliance? You need to be compliant, but not like physically have a certificate of compliance. So you need to stay compliant. So study the FCA regs. Do you need a track record? No, as I said, sometimes it's better if you don't. Returns to investors expect 8 to 15%, depends on how good you are at negotiating. How do you build trust? Building a personal brand, being authentic, showing a work ethic, etc., etc. Can the investor be paid monthly or at the end? Both, depends on how you negotiate. Some investors like it monthly, or some people like it at the end of the project rolled up. What are the typical durations for private finance? 12 months is typically what I do, but you can do 24 months. How often should I update the investor during the project? This is where communication comes in. I would communicate with the investor. Do you want to learn about the project more? Do you want update photos? Or some people say, yeah, that'd be amazing. Or some people go, no, I do not care one bit. I just want my interest. So speak to the investor and see what they say. And then what happens if I leave money in the deal? If you leave money in the deal, go watch my previous video because it shows you the importance of having cash flow businesses as well as wealth creation businesses. Hopefully this has been helpful, guys. It's been a long one. If you made it to the end, thank you so much. Like, subscribe, and if you want to work with me, hit the link below. Bash.